Hello everyone and welcome back to another lesson. This is lesson 4 where we'll be going over the order types available to you, including stop orders, limit orders and market orders. So let's get right into it. So now that we've covered charting and price data, let's take a look at the order types and how to execute them. When you select the drop-down menu on your trading module, you will see several order types. In this lesson, we will cover all of them and when to use them. So you can see in our screenshot to the right, that drop-down menu offers you market orders, limit, stop, stop limit, and trailing stop orders. So let's go over the first one. So first we have a market order. This is one of the most commonly used orders amongst day traders and scalpers. This is the fastest type of order and has fast, immediate execution. However, the downside is that you have no control over the entry price, as if the market moves quickly, you will get in at whatever price is printing, which may not be your intended entry. Then we have limit orders. These are where you have full control over entry price, but entry could be delayed or even missed in fast-moving markets, as this order gives special instructions to execute at specified prices or better. So we've covered the basic two orders, market and limit. Let's look at the rest and also highlight the pros and cons. So first, as we discussed before, we have market orders which have fast, immediate execution, and the downside is you have no control over entry price. With limit orders, you have full control over entry price, but execution could be delayed or even missed. Then we have stop or stop loss orders. These are market orders to be executed at a future price that traders use to enter or exit a trade. The downside of this is that slippage may occur in fast-moving or even spready markets. Another order is a combination order, which is a stop limit order. This is a stop market order and that is executed under price limits. And the downside is it may not execute in fast-moving markets because of those specified limits. And then we have a trailing stop. This offers trade management for traders if they are going to be away from the screens. However, as they are away from the screens, they may not be able to assess the price action, and so a trailing stop can be safer. The downside to this is that it's not the most professional manner to manage trades. As mentioned before, it's better when you're at the screens, you can assess the price action and be better tuned to the market in order to adjust your stop losses. Let's now talk about the order types when we're referring to expiration or duration. So beside the order type box, you will see the expiration of your order. There are two options offered to you. So when you select that drop-down box, as seen in the screenshot, you'll see day or GTC. Let's start with GTC. What does it mean? It means good till cancelled. This means the order will only expire if you manually cancel it. Then you have day. A day order means that the order will expire at the end of the trading day. If you recall, in the previous lessons, we went over the different hours of the trading day. So let's now take a look at scenarios trading stocks using various orders. So we're going to go through an example. We have a screenshot to the right, and this is involving the ticker or equity NVIDIA, which has the ticker NVDA. So let's say we want to buy 100 NVDA at market. Let's look in our screenshot to the right at the two red boxes. In the red box on the bottom left, you will see the required quantity, that's 100 shares, the type of order, which is market, the day expiration, and the buy button. In the second red box on the right, you'll see the ask side of the trading module. Do you recall that we buy on the ask side normally? In our example, after the buy button is pressed, the order will be executed at 495.33 cents, because on the ask there is sufficient quantity, 200, to fill our order at that price. However, if the order was for 400 units or shares of NVIDIA, it will be filled as such. We will take out the first line, which is 200 shares at $495.33. Then the second line below that, which is 100 shares at $495.38. And then the line below that to finalize our order with 100 shares at $495.45. Therefore, the execution price for the 400 shares would be an average price of $495.37. Market orders execute without price limits, and they fit trading in liquid markets, especially if you want to get in and out of the market with fast, immediate execution. So let's say we wanted to sell 100 NVIDIA at market. In our example, the order would be executed on the bid side, and this would be at $495.23 because on the bid, there is enough to fill our order at that price. In the screenshot, we've highlighted the bid in the red box on the left. However, if the order was for 400 units of NVIDIA, it will be filled as such. First, we take out that top line with 100 shares at $495.23. Then the two lines below that from different market makers are both at 100 shares for the same price of $495.20. So that would be 200 shares filled at that price. And then the line below that would be 100 shares at $495.15. Therefore, the total price for 400 shares sold of NVIDIA would be an average of $495.20. So again, market orders execute without price limits and fit trading liquid markets. So let's now look at the buy stop order. Let's say we want to buy 100 NVIDIA at $495.50 using a buy stop order. This is a conditional order, meaning that we are stipulating that we want to buy 100 NVIDIA when the price reaches $495.50 and not before. If there is enough quantity at $495.50, the order will be fully filled at that price. Otherwise, the next price level will be reached to fill the remainder of the requested quantity. Very similar to the market order examples we just discussed. The buy stop order is a market order, and again works very well in liquid markets but may cause price slippage in liquid markets. Let's now go over some other examples using the same screenshot. So, let's say we wanted to use a sell stop order. If we wanted to sell 100 NVIDIA at $495.30 using a sell stop order, much like the buy stop order, this is a conditional order. However, we want to now sell 100 NVIDIA when the price reaches $495.30 and not before. And we'll also use the sell button to execute this order and not the buy button. If there is enough quantity at $495.30, this will be fully filled at that price. Otherwise, as with the buy stop order example, the next price level will be reached to fill the remainder of the requested quantity. The stop order works very well in liquid markets but may cause price slippage in illiquid markets. Let's now talk about the buy limit order. This is also a conditional order, and let's say we wanted to buy 100 NVIDIA when it comes down to $495 using a buy limit order. This means that we are telling the market that we want to buy 100 NVIDIA at $495 when the price is at or under $495 and not before. If there is enough quantity at $495, as with the others, the order will be filled at that price. Otherwise, it will fill partly, only completely when there is enough quantity for sale at that $495 price level or under. Traders often use this order to enter trades at a cheaper price or when they anticipate a pullback to that level, and also to exit short trades at specific profit levels. Next up, we have the sell limit order. Suppose we wanted to sell or short 100 Nvidia at 496 using a sell limit order. This is again a conditional order, meaning that we want to sell 100 Nvidia when the price is at or above $496 and not before. If there is enough quantity at 496, it will fully fill at that price. Otherwise, the order will only partly fill, and it will continue to fill as long as there is enough quantity at the 496 price level or above. Traders often use this order to exit long trades at specific profit-taking targets or to short at a premium price when anticipating a reversal to that level. Next, let's now talk about stop limit buy orders. What if we wanted to buy 100 Nvidia at any price between $495.45 and $495.60? We would do so using a stop buy limit order. This means that we want to buy 100 Nvidia when the price is between $495.45 and $495.60. The stop order activates the trade at $495.45, and the limit part of the order states that the trader is not willing to pay more than $495.60 for the position. This order is a complex one and combines a future entry point above the current price with a limit order as well. Traders will often use this combination to protect themselves in fast-moving and spready markets. So another order of this type is the stop limit sell order, the last order type we will discuss in this lesson. So what if we wanted to sell or short 100 Nvidia at any price between $495 and $494.85? The stop order activates the trade at $495, and the limit, which is put at $494.85, states that the trader is not willing to sell or short below that level. This order again is a complex one, so when you're filling it out and you select it from your drop-down menu, you'll have to enter the stop price, which in this case would be $495, where you want your order to trigger, and the limit section, where the trader must now state the maximum price they're willing to pay. So again, this order is a complex one and combines a future entry point below the current price with a limit order as well. Traders use this combination in fast-moving, spready markets. However, it could be risky to use this order to exit the position as a stop-loss option. And that's it for this lesson, traders. Thank you for tuning in. Looking forward to seeing you in the next lesson. Take care and bye for now.